All right. I'm going to be very simple and short today. For one reason, I'm presenting, I think this is the fifth time we will have picked cognizant technology, so we've certainly talked a lot about it, and I also just want to use it as a teaching point that investing really can be simple, and you don't have to go digging around a lot, particularly with a company in your own portfolio that you already are comfortable with, and that being cognizant. And so you just jump back to the slide, and this is how I picked cognizant this month. I took a look at the dashboard, I sorted it by par, and I ran down down that column, said home away, small company, somewhat speculative. I'm not looking too much at that. I actually did use RIM as a motivator and said that I wanted RIM's charts flipped upside down. So I skipped past RIM. I couldn't resist that, Mark. Figured I had to get that in.
Duly noted.
Jean Penn, again, speculative, and we all know a good bit of what's going on there. Plus, while I didn't dig into it, there was apparently a potential takeover or going private discussion or offer this week by some insiders, and to the extent, I think it bounced up to about 13 or so at one point based on that, so the market must now not be particularly believing it's real credible. But again, when you have those sorts of things going, there's certainly a potential near-term ceiling, if not a permanent ceiling, on the price. So I wouldn't necessarily be selling Jean Penn, but I don't know that I'd be looking to buy it at this point. So I just was going through that sort of a process and pretty much got down into the emphasis, Oracle, BioReference, and Cognizant block. Those are all solid companies. Their pars are all in the same general area, as you can see. They're all very high quality companies, which remember earlier I'm kind of stressing both the quality as well as you can jump over a couple of columns there. There you go, Mark, the financial strength. And out of all of that, you see Cognizant has the second best financial strength. It's the highest quality, and really what broke the tie for me was its growth rate of 21%. So that's how I chose Cognizant Technology. I think while we have certainly vetted it in the past, it's still prudent anytime you take a look at a company to make sure nothing's changed. So you can jump to the next slide again, Mark. And you see here that the 20% or 21% growth rate is certainly not unreasonable given history. And this particular chart does have the analyst projections for 2012 and 2013, and you can see that they do not see anything alarming going on with the company going ahead. They're looking at 21.4% growth over the next couple of years, with solid earnings going along as well. So Cognizant Technology is my pick. Notice Value Line does have it a little on the low side at 10% for the low potential return. But if you actually look at the Value Line numbers, the growth and the profitability numbers, Value Line seems to be in line with what Manifest and basically my own personal Eagle, which is again also in line with the Manifest Eagle with no drastic changes. So Cognizant's my pick this month.
Okay, so another repeat selection, and certainly nothing wrong with shopping within an existing portfolio. You'll probably hear that as a fairly recurrent theme. Before I close things out, and I'll keep it brief because I want to hear about Vertex and get a chance perhaps to kick an apple around. I did want to point out that we did have a relatively magic moment. I don't think I'm the only one celebrating this. Our 10-cup model portfolio, which is a demonstration portfolio in our newsletter, where we actually have a very transparently open managed portfolio. It's again a demonstration portfolio. it passed the $1 million mark. So we have actually had our $1 million moment. It's actually passed it 3 times now because it dipped down below and went back up above, and Kurt likes to hand out ice cream every time that happens. So we've been doing that for the last several days. But to me, and this is a big one, because this is real to me. This is, to me, what this represents is, like a 35 or a 40-year-old person that figures out, can I really still do this? Can I possibly catch up? And if they'd really been putting aside the maximum amount that they could in their 401k since January 1995, it is feasible that this type of thing could happen. And such a powerful demonstration of the principles, because basically this portfolio is managed in precisely the same way that you just heard Cy describe. And I know it's the same way that Ken uses for his personal individual retirement accounts too. So it's not rocket science. It's basically keeping it simple, paying attention to return forecasts, paying attention to quality. Don't get too crazy with things like RIM every once in a while. There's all kinds of lessons to be learned here, because if you actually look at this portfolio, which you can get to from our homepage at any point in time, it's some pretty solid companies. So again, I just think it's worthy of a moment of pause, reflection, and celebration.
Hear, hear.
And
absolutely.
I thought I would point.
Celebration. That is celebration material.
Yeah.
Who wants to be a millionaire? There you go.
And as you know, we've been demonstrating a fund-centered or fund-only version in our newsletter, also with the Horde, and that's just going along swimmingly. We're only a few years into it, but it's just fascinating to see what is still possible, using ETFs and actively managed funds. So more on that to follow. Well, I'm going to close with just one slide, and the slide that I found most interesting to me today was I often will go in and use the stock search function for screening at Manifest World. I'll search on the top percentile based on rank, so I'm shopping instantly amongst the highest, the best potential returns, but not too high, and the highest quality companies. And then I also like to pay attention to the Motley Fool's All-Star consensus, if that's the way you want to think of it. And I like the ones there that they are favorable towards also. In other words, they don't hate my stock. So just entering 99 in both of those 2 slots, I come up with Ken's selection for today and my selection for today, which is Landauer. Landauer is an environmental company that, as it says right down there at the bottom, they provide technical and analytical services, people, software, and stuff to places like nuclear power plants, physicians' offices, any place where you might see an X-ray, any place where you might use radioactive type materials in construction or testing, that sort of stuff, and again, to determine occupational and environmental radiation exposure. So that's what they do. It's not a really big company, but they seem to be very well managed. I would encourage you to go do your own study, take a deeper look at the company. The ticker symbol as shown here is LDR. Chicago-based company. I've actually dealt with some of their representatives in the past when I called on Commonwealth Edison in Chicago back when it was still Commonwealth Edison. So I've actually seen some of their people at work in a previous life, and everything that I read about the company in recent years is quite favorable. So go ahead and take a look. It is the company that was featured as our cover stock for last month. So in addition to catching up on that $1 million moment for Tin Cup, the other thing that we mentioned here about too much in any one sector, where Cy answered the question, too much of a good thing. And then last but not least, you've got a couple days left before we switch to the next issue, and there'll be a new company in there instead of Landauer. I just invite you to take a look. So with that, we can leave the floor open to see if there's any questions. Ken, are there any comments or questions that we need to field at this point?